India's export to GDP ratio is only 21%, indicates a very, very healthy mix of domestic demand as well as the external trade that we do. And service exports are India's strong suit, especially you see IT, consulting, financial services, and we've done some more data analysis out there. We'll show you how much is coming from each sector.
Good evening, everyone, and thank you for joining us today. In this Market Outlook webinar, we will talk about what's happening in the market and what to expect going forward. We have today with us Mr. Vikas Agrawal, who is the founder and CEO of AIF PMS Export India Private Limited, who brings over 25 years of experience in the investment space. He will be sharing valuable insight to help you make informed investment decisions. Over to you, Vikasji.
Okay, thank you. First of all, I would like to take this opportunity to thank Samir for organizing this session month on month. And I'm sure it is helping all our clients to understand the way we are decoding the markets. And also want to thank all our investors who have taken the time out from their busy schedule and joined the call today. Let me just share my screen. So, well, it's been a roller coaster ride across the globe. Everybody knows what's happening around. So we have done some study, consolidated few data points, and my objective is to share these data points with all of you and give you different perspective altogether. So today's theme is basically, as we always say, that don't bet against India. And I'll take you through each of the slides. So I'm going to take about 25-30 minutes time, and then we'll open the forum for question and answer. So let's look at the global indices of the last 1 month. When you look at last 1 month, the data clearly indicates that most of the markets globally and some of the emerging markets are negative. For example, USA is S&P 500 is down about 5.75%. This is March 1st to 31st of March. UK is down about 2.5%. This is not post-tariff. That data is separate. This is only for the month of March. And the data is on 31st of March 2025. So when you look at this data point, clearly this indicates that Indian markets have done very well. Indian Nifty 50 is up by 6.3%. And the other market which was positive, which was recorded positive, was Brazil. So Brazil was also up by 6.08%. But otherwise, when you look at across the globe, whether you talk about France, UK, Germany, all the global markets, most of them have delivered negative returns in the month of March, from 1st March to 31st of March. Now, first we'll cover the global markets and then we'll come to Indian markets. That's how we've divided the whole presentation in 2 parts. So let's look at the global GDP growth. The number which was reported was 6.2% last year. This is a December data that I'm referring to because the March end data is yet to come. Clearly, the quarter, the Jan to March data is also in line with what we are discussing here. So India has moved from 5.6% of growth to 6.2%. That is a positive thing. And so is the China. China also moved from 4.6% of growth to 5.4%. This is the data from April till December. So 9 months of data points. This clearly indicates that when you compare with other markets, and we have picked up some of the best markets which have shown positive growths. You talk about US, China, India, Indonesia, Saudi Arabia, Germany, Euro era, the entire United Unions, and Japan. So India continues to be clearly a fastest growing engine for the world. Across the world, when you look at the data, it clearly indicates that by far India is growing at much higher growth rate. With 6.2% GDP growth, India is ahead of China, significantly ahead of other nations like US and UK and Germany. By the way, Germany has reported negative growth of 0.02%. So, it's like a train that, as we are the 5th largest economy in the world, you have Japan and you have Germany, which is fourth and third largest. So Germany is degrowing and India is growing. So very soon you will see that we are not only going to cross Japan, because Japan's growth is only 1.2%, but we will also reach in line or maybe slightly ahead of Germany in next 2 years' time, and we will become third largest economy. So this highlights India's strong domestic consumption, digital infrastructure that we built about, and the policy support as a key growth driver. Let's look at the inflation across the globe, what's happening. So when you look at inflation numbers, we have taken data. This is the Feb data for India, or otherwise other markets have already declared their data till March. So when you look at inflation numbers for India, inflation has been under control. So from 4.31, which was anyways low, because the RBI's target is their comfort zone is about 4%. Anything which is 4 to 6% is their comfort zone. And India, by the way, has reported 3.61% of inflation, which is even more lower. So that is one way of looking at that. Globally also, inflations numbers are coming down, and Indian markets also, when you see the data, it has come down to 3.61%. So most major economies have seen a slight decline and or maybe stabilization, you can say, in terms of inflation. India is down from 4.3 to 3.6. US is down from 2.8 to 2.4. And Spain, UK, and Japan also shows some amount of easing. So at 3.61, India's inflation is moderate and manageable, falling with RBI's comfort zone that we discussed about from 2 to 6%. And this cooling trend gives RBI more flexibility in terms of rate cuts. And by the way, rate cuts have already started happening, and tightening is not required at this point of time. Let's look at the global GDP projections. Clearly, there are two large organizations. One is IMF, the other one is OECD. They are the one who tracks entire global markets and come out with their own projections. So this projection says that the IMF data point says that in 2024 the world will grow at 3.2%. In 25 it will grow at the rate of 3.3%, and also 26. So next 3 years the globe will continue to grow anywhere close to 3.2 to 3.3%. That's basically the analysis which is done by them. And when you look at a clear path, when you look at this, it indicates that India is growing at 6.2 to 6.5%. The IMF projection for India for next 3 years is 6.5%. So our growth rate is almost double than the growth rate of the entire globe. And other data points, variation in policy rates across countries. Since October, we started witnessing headwind coming from global markets as well as Indian markets from September onwards. And as a result of that, some of the economies have taken the right stance in terms of reducing their rates. The central banks have played an important role. So US has cut down 50 by 50 bips. UK has done by 50 bips. Thailand another 50 bips. Sweden 100 bips. South Africa 50. Japan has tightened the liquidity and increased the interest rate by 25 bips because their economies were having different challenges altogether. India first took a stand of reducing the interest rate by 25 bips and immediately took another stand of reducing it by another 25 bips. So put together, we have reduced our interest rate by 50 bips. So clearly, we have done the study which we talked about last time, that whenever you have low interest rate cycle which begins, that is a time when you see equity performance starts going up, because that's where your cost of capital also becomes even more cheaper. So this is the trend across the globe. Now we'll come to the trades and tariff. Everybody is talking about that. So I thought I'll try and simplify things for all our investors. So we picked up the data of G20 countries, and we looked at what is the correlation of these countries with, in terms of export of their GDP. So, when you compare this with US, clearly it says that European Union's, their export percentage is as high as 51%. South Korea is about 44%. Germany is about 43%. Mexico is about 35%. Saudi Arabia is about 34%. Saudi is because of their oil exports. France is about 34%. Canada is about 33%. Italy is another country which is dependent on export by 33%. Turkey is about 31%. United Kingdom is 31% again. South Africa is 32%. Australia is 26%. Now, our case in India, it is only 21.85%. And I have few more data points to bifurcate this in the next slide, where I'll show you how our how our growth is coming. We bifurcated further in the further slide. I'll show it to you. So what I'm essentially trying to tell you here is that India's export to GDP ratio is only 21%, indicates a very, very healthy mix of domestic demand as well as the external trade that we do. And service exports are India's strong suit, especially you see IT, consulting, financial services, and we've done some more data analysis out there. We'll show you how much is coming from which sector. So this indicates that our overall export, percentage of GDP to export is only 21%. So clearly, this shows how healthy we are as an economy. Then we've done some analysis on top mercantile trade surplus and deficit country. So, the number one is China. So China's export is surplus to the US is about $820 billion, is nearly equivalent to the combined surplus of the other top surplus nations. USA's deficit, by the way, is highest. $1.15 trillion is the highest. So they are trade deficit country. USA is deficit by $1.15 trillion, highlighting strong import dependence. So US as a country is completely dependent on imports. India, UK, and France also shows large deficit. So we as a country is not completely dependent on export. Rather, India, UK, and France we are in deficit side. When you look at the numbers, India is about minus $240 billion. So our import is much higher than export, and this clearly indicates that no matter what happens, that we are not as affected as other countries are, as far as this tariff is concerned. And Russia and Saudi Arabia remain surplus leader due to their energy export. Russia and Saudi Arabia is known for exporting their crude and other energies related stuff. And trade gaps reflects global demand supply imbalance. So this chart is completely giving you understanding, first of all, that United States as a country is deficit by $1.15 trillion. On the other side, China is surplus by $827 billion. That's a huge number. And here is a summary of US year-to-year trade from Jan to Feb data, and focusing on top trade partner, export and import both, and their trade balance. So what is trade balance? Trade balance is the total trade, and then you have deficit, and then you have surplus. So the total US trade, is about $937 billion, and out of which, they had export of $332 billion, and import is almost double, which is $605 billion. This is the data that we picked up just to decode how economy is shaping up. And when you look at the top trade partners of the US, it is Mexico, Canada, China, Switzerland, and Germany. Look at their numbers. Mexico holds about 14.7% of the number that I'm talking about, the total US import versus export. When you look at Mexico is about 14%, Canada is about 13%, China is about 10%, Switzerland is 5%, Germany is 4.1%. Now, when you look at and top down, then India comes at 12th position again vis-a-vis US. And export to India, what they export to us is only 2% of their trade. I mean, US as an economy only export 2% to India, and they import 2.7% total. So if they have 100 rupees, for example, of the total trade, the trade balance, only 2.7% of their total import, which is only $16.5 billion. And the total trade, when you combine and put together this, is coming to about only $23 billion. So, with this tariff, the rates, Trump President Trump is talking about, as far as India is concerned, we are too far to get affected deeply about whole tariff war which is happening across the globe. So again, as I said, that United States recorded the highest 937 billion of trade, out of which 332 is export only, and double 6.5 is import. The top 15 countries account for 75% of this trade. And top trade partners I talked about already. Then another data that we've analyzed is that when you look at top US trade surplus, so US exports to Netherlands, United Kingdom, and UAE. And look at the numbers, very small, which is $8.4 billion to Netherlands, 3.48 to United Kingdom, and 3.38 to UAE. On the other side, look at the deficit. So the deficit number is almost 52% comes from China. And you know what is the tariff rate that they are putting on China? Numbers are crazy, 3-digit numbers, and the trade war is going on. They are putting one number, then the other country is putting another number. Switzerland is about 39%, the deficit to US. Mexico is about 28%, Ireland is about 26%. Your Vietnam, a very small country, but look at their US trade deficit, which is about 22%. And India is only 9.8 billion, which is about $10 billion. And it is at sixth position as far as the trade deficit is concerned. And our government is continuously engaging with them in terms of defining some new numbers. Let's look at US trade balance. So, we picked up the data from 2013 balance with China, and then we compared that with India. This will give you clear-cut picture how small our numbers are vis-a-vis their numbers. So 2013, US deficit was 3,80,683. This is in $1,000,000. And numbers are going up. This we picked up 2025 data also, which is about 52,000 USDs. But when you compare that with India, look at where India used to be. 2014, when you look at India, it is only 23,858 USD. Vis-a-vis China, which is almost more than 10 times. So this data also clearly indicates that we are nowhere in terms of coming closer to US in terms of exports. And the case that I'm trying to make here is that despite whatever is happening, you will see that India is not going to be as affected as other countries are. Rather, as our Prime Minister says, that this becomes blessings in disguise in terms of creating an opportunity to do more and become a significant player in the global supply chain system across the globe. So this is the consumer sentiments, another data that we picked up, and we saw huge fall there. What is consumer sentiment? So consumer sentiments clearly indicates that people don't want to spend money, and this data suggests that there has been huge amount of decline, between Feb to March, almost 11%, and why year on year change when you look at it is 28%. So consumer sentiments are declining sharply across the globe, and more so in US. And two-thirds of the consumer now expect rising unemployment. It is the highest in 2009 as far as US is concerned. And the expectation index fell by 18% month on month, showing deep pessimism about the future economy in the US. So this data suggests that there also people are really concerned about uh, this tariff war which has begun. And this is the market outlook where we talked about how our share, India share, to the US in terms of export. What is our share as far as sector wise allocation is concerned? So when you look at, for example, chemical industry, so we have only 4.3% of market share when it comes to US export, whereas our tariff rate is only 26%. And we are comparing with whom now? China and Switzerland. And China has, by the way, 13.7% market share in the US as far as chemical is concerned. And Switzerland, by the way, nobody would have ever imagined, has 5% share when it comes to exporting chemicals to the US. Then look at electronics. We are nowhere, only 1.8%. And China is about 24%. So 24% of the electronic business which happens in the US is actually exported by China. And Vietnam, small country again, 12%. And look at their tariff rates and look at our tariff rates. And clearly this indicates a lot of opportunities for Indian electronic manufacturers to think about scaling their business, think about exporting their products. All they need to do is to improve the quality of the products. Then look at textile. Textile is 8.3%. Now Vietnam is having 19% market share, and Bangladesh, it's a small country again, but 10% market share. And we as a country, much bigger than Bangladesh, having only 8.3% of export to the US. And our tariff rate is much lower than these countries. So again, this is opening up immense amount of opportunity for country like India to do more business with US. Then post tariff, what happened? Let's look at the data. This is what I was referring to. Now, ever since this tariff war began, we saw Dow Jones, correcting by 7.5%, almost 7.3%. When you look at emerging markets, clearly some of the markets have also, like Swiss market is down by 7%. The DAX is down about 5%. Eurozone is down about 6.95%. Euro Stocks 50. But when you look at Asia specific, India has delivered positive return of 2.23%. Now, there's a saying that market is smarter than anybody else. And this number clearly indicates that despite this tariff war which has begun, India is the only country which is not affected and delivered positive returns vis-a-vis the other countries which are down to the tune of 7-8%. So this really shows our resilience to the world, the Indian resilience in terms of the economy. Now, this is the RBI baseline forecast for GDP. So RBI is and IMF both has projected 6.5% of growth for India, and the CPI inflation number very much under control. This year going to be 4.7. Next year we assume that is going to be one more lower, which is about 4%, and will get settled at about 4.5%. So because of the GDP as per NSO second advance estimate, inflation average up to the February, the number that we have taken. What is driving this number? The growth resilience, as I talked about. India's GDP is projected to stay strong at 6.5% to 6.7%. And because of what? A rebound in private consumption and agriculture, continued optimism in service and infrastructure, and sustained government capex and public investment momentum. And I'll give you the data also for that in the next slide. So this clearly indicates that when you look at the support level for India, so one is that inflation numbers have come under control, And the key driver is cooling oil and commodity prices. We are the largest importer of crude oil across the globe. And second is our improved global supply chain, which has already started showing positive results from last year, and the monetary tightening. All of them have worked well, and this trend gives the RBI policy room to support the growth if needed. And 50 beeps of reduction clearly indicates that our government of RBI is also equally keen to support the growth. Now let's look at what happened last year in India and what is happening this year. And I told you we've done some bifurcation there. So broadly, look at the GDP where into 2023 and 2024 last year, and comparing this with this financial year, which happened 24-25, which is gone by. Your private consumption moved from 5.6% to 7.6%. So rising consumption, which is again consumption story is very strong. What has affected is the government spending, government expenditure, which was projected at 8.1% because they had a target of, investing about 11.11 lakh crores. And because of last year's hard monsoon and government of India got involved in various state level elections like Maharashtra, Haryana, they could not manage to achieve these targets, and therefore because of the lower government spending in 2024 and 25, we saw major declining happening. On the other side, because of the government spending has reduced, the private spending, the private capex, because of the utilization numbers, this also shrink by another 2%. So it has come down from 8.8% to 6.1%. But what has worked for us is that our imports started declining because of the crude oil declining, and our exports started improving. I shown you the numbers of the export. So as a result of that, somehow we achieved this number. And by the way, this year we want to see more of private consumption. Government continues to remain strong on achieving the numbers and also doing the shortfall of the last year, over achieving that. So this year they are again targeting about 11.5 lakh crores of government expenditure, and when you add up the state, it comes to about 14.5 lakh crores. And the private consumption, which is likely to pick up. All these numbers clearly indicates that we are confident about achieving 6.5% growth rate vis-a-vis the globe, which is at 3.2 to 3.3%. So almost double despite this global headwind. Now let's look at, there's a discussion between rural and urban, the consumption trend. So some of the sectors that we picked up the data for. So we saw that as far as urban is concerned, we saw air passenger traffic going up by 11%. Passenger vehicle shown some amount of positive results after September, October to February. This data is for 5 months. And consumer durable has grown by 9%. Your household credit has grown in double digit. And FMCG has also improved some amount of growth, but below the rural growth. Now let's look at rural consumption. Tractor sales has gone up significantly, strong growth in H2. FMCG sales outpace urban. I just said that. Fertilizer sales turned positive in Q3 and Jan and Feb. Jan. But only thing concerned there is the motorcycle sales have shown some amount of decline. But supportive factor is that this year is going to be good crop, and overall the rural demand looks to be much better. Now, what happened last year and what is happening this year? We saw a lot of issues coming up last year, a lot of headwinds I talked about. We saw increase in currency in circulation overall. Government also spent some money during election. We saw drained system liquidity. We saw capital outflow, liquidity leakage via forex operation. RBI was doing a lot of forex operation. We have maximum amount of US dollar reserve. We bought maximum amount of gold last year, last year. And then we saw advanced tax outflows, seasonal tightening in December particularly, net forex sales, further liquidity drain, and volatile GOI cash balances. Because of this, But what the government of India, immediately RBI, because of their nimble and multi-pronged approach, they came out with 5 different solutions. First thing first is they reduced the CRR. CRR is, is that, like, if you are running a bank and you're getting a deposit, you have to maintain X amount of money with RBI. So they have uh, cut down the rate of that, and as a result of that, we saw 1,16,000 crores of money have been injected through banks. So far, this is permanent, so there is no reversal case. OMO purchase is for long term. This is happening on a regular basis. We saw term VRR auctions, which is about 1,70,000 crores. This is the range which RBI gives to the bank to take borrowings from reverse borrowing from the RBI, and it generally is for 1 month to 3 months time frame. So that also has been sort of made nimble. And US INR buy sell swap. So this is basically money which is for long term, from 6 months to 3 years time frame. That is about 2,80,000 crores. So put together, almost 8 lakh crores of liquidity have been infused by our central bank. This is the total trade. In the previous slide, I told you that we want to talk about the total export. Export is divided in broadly 2 parts: your mercantile value and the services. So, and then we've compared this of the last 2 years. I told you that we are getting good support from export as well. So let's look at that number. So when you look at 2023 and 24, which is last year, and compare this with this year, we saw 6.5% of overall export growth. For example, merchandise export is remain at same level, $395 billion, but service exports grew from $311 billion to $354 billion. This is last 2 year data point, because I told you that last year we got very good support as far as export is concerned. Now let's look at the import number. So 23, we had $621 billion of import, which went up by 5% another, and mercantile import is about $656 billion. But when you look at the service import, it is $161 billion to $183 billion. And therefore, we had trade deficit of $89 billion vis-a-vis $76 billion. So while the number has gone up, but what I'm essentially trying to tell you is that overall trade balance numbers have gone up, but the export component, particularly in the service sector, which is broadly IT and financial services, have grown positively for us. And as a result of that, you see that service is positive by 14% and mercantile trade deficit is 15%. So our government is clearly trying to improve the export numbers and trying to reduce the import numbers, and working towards that, and talking to other countries as far as free trade agreement is concerned. They've already started speaking with European unions, and looks like with whatever happening, we are only 3 to 4 months away from that. Let's look at what's happening in India in terms of GDP collection. Now, GST collection, sorry. So GST collection will give you some amount of sense that whether these numbers that we are talking about is supported by these tax collections or not. Now, when you look at the whole year from April to March, because March reported almost 1,95,000 crores of GST collections, which is 9.9% of YOY growth. Overall GDP growth, GST collection has grown by 9.4% YOY year on year. Slightly below than the nominal GDP, because now nominal GDP was recorded at 9.7%. Ideally, this number should have been in double digit, but we are not too far from that number. We still managed to deliver collected about 9.4% of the nominal GDP growth. So this clearly indicates that going ahead, we see more GST numbers strengthening and collection. This indicates that how economy is shaping up. Now, total net flow of the FPIs. So when FPIs, first of all, they have been the net seller, you know that. Uh, in the month of September, they sold stocks worth rupees more than 1 lakh crores. Again, they did the same thing in the month of January, and they sort of went out and invested in US. By the way, it's a wrong call for them because US is also down about 7%. So they booked losses here as well and there as well. But anyways, let's look at where the money is coming. So money was only $5 billion, by the way, which came in. And maximum amount of money has either gone in financial services as far as stock is concerned, or maybe souvenir bond fund, because you know that now India is becoming a global economy in terms of fixed income markets also. So uh, uh, we saw good amount of money coming in the form of souvenir bond fund. But as far as industry is concerned, they invested in financial services industry, they invested in telecom industry, healthcare, power, capital goods, and they have been negative, and they've been selling sectors like construction materials. They were marginally sold about -3%, but otherwise, when you look at you know the fast moving consumer, they were negative by almost 57%, and consumer services is about 135. IT, they have been the net seller. They're selling ITs like left, right, center with -177%, and oil, gas, and consumables, which is about 268%. Now let's come to where we are in terms of the valuation as far as Indian economy is concerned. But before we move to the valuation, let me just show you the data points. Even when you look at last 1 year, Nifty 50 still delivered 6.65% returns, and your Nifty mid cap 150 has delivered 8% return in the last 1 year, and Nifty small cap as index has delivered 6% returns in last 1 year. Now, by the way, that's not the level across the globe. You saw what's happening across the globe, and this number still looks healthy in terms of the returns. Now look at the valuations. From a valuation perspective, uh, last month we were at about 19 ka P as far as large cap is concerned, and historical P is about 18.7. We are very much closer to that. We are at about 20 ka P as far as large cap is concerned. Mid cap looks to be little expensive, looks to be little still in expensive zone at about 28 P, and small cap has come down from 28 to 23.2. So clearly large cap and small cap, these are the two areas where I would suggest that those who have low weightages to equity as a family, we would suggest them to increase your exposure there. One disclaimer here is that when you look at the historical average number of small cap valuations, which is showing at 17.3 P, well, those were the days when we did not had good amount of earnings also, and not good quality index also. Now, in the last 4 years, we saw some of the small cap companies started reporting good numbers, so the earnings are really supporting those numbers, and we saw that some of the good quality companies entering in the index. So index itself has become little expensive. But having said that, this is at 23%, the small cap. Uh, while the premium number looks to be high, but as I said, this is supported by earnings. This is a market cap to GDP number. So 24, we had 129%, which has come down to 108%. This is referred by Warren Buffett. And another important chart is advanced decline ratio. What is advanced decline ratio? Is how many stocks are going up and how many stocks are going down. So strong start, when you look at ratio of 6, it is 6, highest in Q1. We saw post February, that numbers have started improving. Number of stocks are going up vis-a-vis the number of stocks which are going down. So with that, I'd like to conclude my presentation here, and I would like to thank you for giving me patient hearing, and I hope that you can use these data points and make your portfolio accordingly. Now I'll hand it over back to Samirji if you have any questions.
Yeah, one question is here, Vikasji, that as you said that tariff war is going on. So what kind of impact you are seeing on our Indian economy? If
Yeah,
you
so Samir, see, there is a concern if markets will correct across the globe. India is not isolated, but with the numbers that I have shown you, our correlation is much lower than other countries as far as US is concerned, and our tariff rate is much lower than those, and that has been paused for 90 days. But I'm saying even after 90 days, the rates which have been defined is very low. So clearly, we say that India as an economy is fully prepared to deal with this situation, and I would say that it is blessings in disguise that we would utilize this opportunity to improve our exports and be a significant player in global supply chain across the globe.
other question is that are you seeing some more downfall in Indian equity market or this rally will get continued?
Well, very difficult to say that. I think, there's a saying that if Trump is there, then volatility will continue to be there. So after President Trump taking over, it's very difficult to predict him. So you will see a couple of measures taken by U.S. economy will definitely affect uh, markets globally. And as I said, India is not isolated. Our numbers are clearly indicating that although we are doing better during this crisis, but volatility may be there for some more time.
So thank you, Vikasji. Definitely, this data point will help our investor to take informed decision for their investment. So thank you very much, Vikasji, for all your insight.
Right. So before I conclude, as I said, the theme of the presentation is don't bet against India. India as an economy, is fully prepared to deal with these kind of situation. When during the crisis, you saw uh, we had crunch of oxygens, and you saw how our honorable prime minister got himself involved in the whole thing, and supported the Indian economy. They didn't know even how to produce that kind of oxygens, that kind of quantity. If they can deal with these kind of situation, I am more confident that they are ready to work closely with these Indian corporates and support them to export. Number of PLI schemes they are likely to increase. They are working on revamping GST numbers for some of the industries. They are supporting exports, coming out with more liquidity stance. Interest rates have been reduced. Uh, Government spending will go up. Inflation numbers have been under control. So I think India is fully prepared to deal with this situation, and I have no doubt in my mind that we will continue to grow at about 6 to 6.5% even this year.
Okay. Thank you, Vikasji,
Thank
for
you.
all your insights and data. Thank you very much.
Thank you.